Hello, everyone. Good morning. Thank you for having me. It's an honor. It's my first time in Poland, and so far, I love the city. So let's start. A little bit info about QM Ventures. QM Ventures is a CVC arm of one of the biggest financial institutions operating in Turkey and MENA. We do early stage investments. Our average ticket size is around $350,000, but we can follow on up to $1 million when we do investments. This is like a 2020 vintage fund, so it's been like 2 years since we started this. And so far, the markups are going good, and we cross the fingers, hope we will end this 10-year fund with great results. We invest, by the way, in fintech and fintech adjacent markets, B2B SaaS, enterprise software. Those are some of the verticals that we're really interested in. We're a strategic investor. That means besides looking for financial benefits and gains and wins, we look for strategic angles, synergies. When we want to invest, we look for some win-win scenarios that we can partner with these startups, these companies, when it comes with the relationship with the bank or the other group companies that we have. A little bit about myself. Like I said, I'm a founding partner at QM Ventures. Before this, I built 2 accelerator programs. I worked with dozens of companies in Istanbul, usually, and helped them from getting from 0 to 1, helped them with fundraising millions of dollars. And I also have some board seats in some companies of our portfolio companies. So, before we start, I want to give a disclaimer. I want to make a disclaimer. These stuff I'm going to talk about in the next 10 to 15 minutes, it's a collection of the stuff that I've witnessed personally, and I saw it worked, and I read about it, I listened about it from my peers in the VC ecosystem and everything. But the thing is, if you don't have a great team, a perfect traction, or a really exciting TAM, total addressable market, although this stuff could be helpful, it's not a guarantee that you will fundraise, obviously. And in a market like this that we're in right now, as you might probably read and hear about, it's getting tougher to fundraise. The valuations and the multiples that used to happen in the last, let's say, 1 to 2 years is kind of gone. Especially in the US market, the public markets, as you know, kind of crashed, and all the expectations are getting deferred. So this is a tough time right now, but I'll tell you this. If you run a perfect process with your fundraising, even though you don't have a perfect team, perfect traction, and perfect market, you will really increase your chance of fundraising. It will definitely help. And actually, you don't have any other chance in a market like this. So that was my disclaimer. Let's get started. Play the numbers game. What do I mean with the numbers game thing? As you maybe experienced or about to experience as founders, fundraising is a sales and marketing process, right? You have to have many, people interested in your company, at least aware about your company. You have to interact with a lot of people, and that means that you have to bang a lot of doors. Sometimes I hear from founders when they're about to get fundraising or start the fundraising process, they tell me I'm in touch with 3 angels, I reached out to 4 VCs, and I say, if it's not over 100, you're not doing enough. It should be 200, it should be 300. And to be honest, like I said, I'm from Istanbul, and Istanbul is kind of considered outside of Europe, obviously, when it comes to VC mandates. So the Turkish founders have a lot of, they have to do much more to get that interest from European, US VCs, not the local ones, obviously. But when it comes to a Polish ecosystem, you guys have a lot of capital allocators in Europe, in US, in the other parts of the world that could technically invest in your company because you're part of Europe. So you have more chance, actually, what I'm used to in Istanbul, Turkey. You should definitely like talk to many people as much as you can. And besides, like, if you have like 10 people interested in your company versus, like, sorry, if you have like 10 people interested in your company versus 2, you're guaranteed to have more, like, better terms when you get that term sheet, hopefully, if you have. Because there will be more people around the table interested. You can shop around, right? You can talk with the VCs to have the terms much better. So you have to talk with a lot of people, a lot. How do you do that? You can't just basically, cold email everybody. I have a point about that as well. You have to build relationships. So I always say, like, fundraising should be 724, 365 days a year. You should be always in a fundraising mode. That means you should be always building relationships with VCs. How do you do that? You have to find connectors. I mean, that could be someone who's close friend to that VC. That could be a portfolio company founder that you can befriend. That could be the associates or analysts who could be maybe much easier to get connected instead of the general partners, the managing partners, those guys, the decision makers actually of the funds. But you have to build those relationships, because if you don't have amazing traction and you just cold email a VC and say, this is our traction, we're about to close a round, or we're about to start fundraising, are you interested? Nobody's going to say yes, like, it's you, because you're coming out of the blue. They have no idea about you, they don't know you. It's like, who are you, right? But if you build a relationship with them in time, and when the time comes for that actual fundraising, you can have them pull that trigger. You can say, you know me, I know you, you know how I execute, you saw my journey, like, since we met, and now I want that money, and people are, I think, gonna give. Are you also willing to give? Then you can pull them. But because you've built that relationship, that decision to allocate capital into your company would be much, much, much easier for those investors. So you have to build relationships. By the way, one of the good tactics is always, interacting with these VCs on social media. If they're active in Twitter, which could be the high possibility case, you can interact with them. And you can make sure they are aware of you. And then, when the time comes, you will have those serious talks with them. You have to find the Sherpa. What do I mean? If you don't know, Sherpa is like the people who are helping the mountaineers climb to the top in Himalayas. So fundraising is kind of like that. There's like a huge mountain and you have to climb it. So you have to have someone really close to you that can help, which is also close to the VC ecosystem. That could be your existing investor. Maybe you had some angel investments before, and that could be someone who already believed in your company, you have a good relationship, and they know the circles, right? Because VCs talk to each other a lot. And as a founder, maybe if you're not a repeat founder, a serial entrepreneur, maybe you're doing this for the first time. But VCs, like, that's their job, right? They know what's going on in the ecosystem. They know who passed why. They have their own competitions among them. So if you have that Sherpa next to you, they will definitely help, and it will be really critical in your fundraising process. Think about that. Who could be my potential Sherpa? And how can they help me? Well, even if you're messaging a VC and you get some replies, sometimes what they say is not what they meant. But if an investor sees that reply, they understand. They're like, okay, he's not interested, or they're really interested. He doesn't tell, but they're really interested. Or maybe they can back channel. This Sherpa can back channel when you're fundraising. They can help you navigating this maze, which takes a lot of time. It's just like the entrepreneurial journey with ups and downs. You're going to get lots of no responses. But that Sherpa would be really critical. And to be honest, what I do as an investor when I'm really bullish about a company, and to give you a context, we always want to be like the first ticket, the first institutional ticket. I'll tell them, I'll be your Sherpa. Like, I'm going to be your Sherpa. Don't worry. I'm be on your side. We're going to play this game together. I'm going to help you fundraise until we get the capital we're looking for from the best investors that we can find and we feel could be a good partner throughout this long journey. So what do you do next? You have to set up your investor funnel CRM pipeline. Remember the sales game, the numbers game, sales marketing analogy. You have to kind of have this kind of a sheet. It could be a Trello, it could be like a different tool. I made up this one. So I have the fund, the partner, the connection, who connected us or who can connect us. In this case, I said it's the portfolio company of Andreessen Horowitz, and we're befriended Jane. She likes you, she knows about your company, she can introduce you to Andreessen Horowitz, and especially if Jane is one of the good ones in their portfolio, they will definitely take that meeting. Because if Jane tells that Joe is good, we should meet Joe. So think about that as well. The date of last meeting, which is really critical, sometimes people miss that one. Like, they say, when I talk to a founder, who did you talk to? They say, let's say, I've talked with Andreessen Horowitz. Like when? Was it like 1 year ago? Like 2 weeks ago? Because in the last 11 months, like, whole of stuff happened to your company, and I know that. So you're a different company right now. You have to touch base with them. Type of the meeting, it could be a coffee, it could be a Zoom, it could be an on-site thing. Well, what happened on the meeting? Like, you don't need to put the whole script, obviously, but what happened? He said, he questioned the GTM. He asked some questions about our go-to-market strategy. What's the next step? Really critical. So what's going to happen? He said he's going to talk to Ben Horowitz, and I'm going to send them the financials. You need to have this kind of sheet. And like I said in the first point, this sheet could be like, should be filled with a lot of data, like with 80, 100, 150, 200 rows, right? So you have to have this kind of setup. You have to have a teaser deck. What do I mean? Or an email deck. You have to have a short, sweet, precise deck which will make you get that meeting. So I'm not talking about having that deck opened and you explain about it. Not that one. The one which maybe your Sherpa sent to them, you sent them, you just show them and they get excited. It kind of gives them excitement and they get curious and they say, okay, I want to meet with you. Let's have a 30-minute call. Let's have a one-hour meeting. And what could be the narrative? This is my go-to narrative. You have the cover page, your logo, your one-liner. What is the problem you're trying to solve? What does the world look like right now? The solution, the future set, could be easy. Business model, you can leave that out as well. Sometimes I say, let's leave this out because it's so obvious how we would make money. I'll put it in the appendix. And why? Because it could change, right? It could change. I'm talking about early stage funding and companies, by the way. It could change. The market, and with the market, one mistake, not a mistake, but something I see a lot and I don't recommend is like having, let's say, AI market is like a $5 trillion market, and this is the that serviceable market. And if we get 1% of it, we make a lot of money. That's kind of bullshit. Like, why not 2%? Why isn't it 0.5? I don't recommend this top-down approach. I always say let's have the bottoms-up approach, which I always see for instance, in the Y Combinator presentations and other decks that are doing well, in fundraising. It says like, there are 5,000 enterprise companies in Poland. This is our ARPU, average revenue per user. That's what we think we can earn. You just multiply them, and this is the yearly opportunity. That's it. It's not $5 trillion, but it's like $40 million. And you give like a reasonable number there. Obviously, you can have the question, but we're not going to be able to get the 5,000 companies all together. I mean, we're not going to be able to do that. But still, it gives a better idea about the opportunity, right? I always suggest having bottoms-up market slides. Competition, obviously, who are out there. And don't think about always direct competition. Sometimes people don't think about the jobs to be done that you're trying to do. So maybe there are other entities who are attacking to the same wallet with a totally different style, who are incumbents, there are old solutions, whatever. They can be in direct competition as well. So don't miss out that one. And obviously, tell how you stand out. You have to show how you stand out. Traction, obviously, I think if you would ask me, like, Ozge, if we have just one slide, which one would you show? I'll say, can we have two? And if you say no one, I'll say, okay, then let's go with the traction slide. And you might say, like, we're a pre-seed company, seed company, we don't have that much traction. Wrong, you do, because you did something so far. Like, if you didn't just came up with the idea yesterday, you did something. You talked with people, you got some insight. In your previous company, you had some sort of experience. So you can find stuff to put into that slide. I'm pretty sure, I'm 100% sure. But if you have like proper traction, like MRR users, never give static data. Don't say we have 200 users. Like, was it 199 6 months ago? Or was it like two days ago? You have to show the velocity, the growth. Don't forget, startups are always about growth. Are you growing fast? Obviously, in this market, are you growing profitably fast? But still, are you growing? So you always need to show some sort of velocity, because that gives the reader audience, that gives that message about this is where we are right now, and look where we were, and think about how what we can become very soon. So that's really critical about the traction slide. Team, the second most important slide in an early stage company, because you don't have that much to show off, right? But the team, you always hear about investors say, we bet to the jockey, not the horse itself, meaning like we bet to the team, not the market, not the product, because a great team can find a better market, can find a better product. So team is really important, but don't just put your names and say CEO, Ozge, Jane, CTO. That's very bad. Tell what they did before in short, sweet sentences, so we can understand you're the team to win this market. Because there are probably many other teams that I saw before, or there are existing incumbents or big companies, but this team is really exciting because this guy did this before, and they have a huge experience in this field. Or maybe they don't have any experience, but they look like really good winners. And put social creds on that slide. Show the companies you worked at, not the ones that nobody would know, but because when I see that slide, I have to say, okay, this team looks interesting. They did this. Okay, I have to take this meeting. These guys looks interesting. Ask. We're raising $300,000, and we will use these funds with this chart, pie chart, 10% marketing. That's bad. Don't do that. What you should do is this. We're raising $350,000. This is where we are right now. We think, we hope, we believe this will be the milestone we will achieve after we get this money. Like, give me that money now. 2 years later, 1 year later, this is what we're going to turn to be. And most probably, this is where we're going to raise the next round with this valuation. So give a sense where the company will go, right? And the summary, quick summary, so that the person looking at it can have a quick look at it and say, okay, I got it. Moving to the sentences as slide titles. Don't have team, problem, solution on the slides. That's boring. Use sentences, just like this one. Why? This is the most important real estate on your slides. Everybody will look at that part. And if we read those slides from 0 to all the way up to the end, we should understand the narrative. We don't need to look down. We just read the sentences, and we understand. This is the problem, this is the solution, this is the team. Wow, I need to take this meeting. Use DocSend or something like that, so you can track who opened your deck, how long did they look at it, how many times did they look at it, which slide did they spend time on it. Some people say just send the PDF, the PowerPoint. I don't agree. sent with DocSend so you can track. Because sometimes you send the deck and you don't even know whether they looked at it or not. Like, are they even interested? Do not spam. Never just cold email everybody. Do personalized messages. Ozge, I just watched your keynote on Wolf Summit. That was great. Is there a chance that we can talk about my company, which I'm doing this? Don't just spam everybody. Because if you're not doing 5-minute Googling about the investor, that's a very bad signal. Like, if there's not spending 5 minutes about me. It's not about ego, by the way. Like, this guy is not a hard worker, maybe. Test drive first. Don't start with Sequoia. Like, even though you want them very bad. Start with the other, B, C, tier 1, 2 investors, so you practice. Practice your narrative. Know your metrics on top of your mind. CAC, ARPU, LTV CAC, burn multiples. You have to know them very well. Even though sometimes you don't know them very well, just say it. I don't know. I don't have it right now. I'll get back to you very quickly. Ask direct questions. Sometimes the founders have investor meetings. They have no clue what happened. Like, you have to ask. So you listen to my company. Do you think it could be a fit to your fund? What do you think I should do so you could be excited to give me money? Ask direct questions and get direct answers. They will have to give you that answers. Leverage FOMO. The more people on your table, you have to play that game. Like, this investor is about to give us some commitment. Maybe sometimes you need to name drop them. Maybe you can't do that. But you have to use FOMO, fear of missing out. Some VCs might say we don't get triggered by FOMO. That's a lie. Like, we're all humans. Everybody gets excited or feared out about some great opportunities. Use FOMO. FOMO is really critical. Don't fixate on valuation. We think we're a $5 million company. That's why we're not going to get less than that. Don't fixate on that. Have an anchor and say, we think this is the market for us, but we can talk about it because we're not fixated on the valuation, but we're more optimized about the money we're looking for because that's the capital we think it will take us to the next step. Show confidence. If you don't have confidence, nobody will believe in you. You have to show that confidence without getting so cocky and arrogant, obviously. And do your own due diligence. Ask about the VC to get intros to their portfolio companies. Tell them, can you intro us to the companies? And so they will introduce you. So you will know how they treat them in the good days and the bad days. Beware. None of these are term sheets. I think I liked your company. It's not a term sheet. We were really excited. It's not a term sheet. And even sometimes a term sheet isn't even an investment because it can fail through as well. Until you see the money in the bank, it's not done. Thank you very much. I think I'm really over my time. My name is Ozge. You can reach out through my email and my LinkedIn. Thanks, guys.